The government announced inflation was 3.1% last year, but your rent went up 8%, your car insurance jumped 14%, and you're pretty sure your grocery bill didn't get the memo. You're not imagining it, and the official number isn't lying. They're measuring different things. When economists and news anchors talk about inflation, they're usually citing the Consumer Price Index, built and published monthly by the Bureau of Labor Statistics. The CPI exists because the Federal Reserve needs a standardized thermometer for the economy. If prices rise too fast, the Fed raises interest rates to cool things down. If prices fall or stagnate, they lower rates to encourage spending. But the economy is 330 million people buying millions of products, so the BLS can't track every transaction. Instead, they sample. They send data collectors to stores, websites, and service providers in 75 urban areas to record roughly 80,000 prices every month across about 200 categories. That sample represents what a typical urban household buys. Not what you specifically buy, not rural buyers. A weighted average of common purchases. The Consumer Price Index is a basket. Imagine the BLS fills a shopping cart in 1982 with everything a typical household bought that year, calculates the total cost, and calls that the baseline. Every month since, they price out that same cart. If the 1982 cart cost $100 and today it costs $314, the CPI is 314. Inflation is the percentage change. If last month's CPI was 310 and this month it's 314, that's a 1.3% increase. Annualize it, and you get roughly 4% inflation. The basket adjusts over time because people don't buy Walkmans anymore, but the idea stays the same. It measures how much more money you need today to buy the same stuff you bought before. The basket isn't evenly split. Housing takes up about 1/3 of the index because it's the biggest spending category for most people. Transportation is roughly 16%. Food is 14%. Medical care is 9%. The rest gets divided among education, clothing, recreation, and miscellaneous services. When the BLS calculates the overall CPI, a 10% jump in rent has way more impact than a 10% jump in movie tickets because rent is a bigger slice. That weighting reflects average spending patterns, not yours. If you spend 50% of your income on rent because you live in a coastal city, the CPI underweights your reality. If you drive 90 miles a day for work, gas price swings hit you harder than the index suggests. Now here's where it splits. You'll hear two inflation numbers, headline and core. Headline CPI is the full basket. Everything. Core CPI is the same basket with food and energy stripped out. Food and energy prices swing wildly month to month because of weather, oil supply shocks, and global commodity markets. A hurricane in the Gulf can spike gas prices 20% in 2 weeks, then they drop back. Core inflation removes that noise so policymakers can see the underlying trend. If headline inflation is 4% but core is 2.5%, the Fed knows the spike is mostly oil and oranges, not a systemic problem. If core inflation is 5%, that's stickier. It signals broad price pressure across wages, services, and goods that don't bounce around. Here's the part that confuses everyone. The CPI measures price changes, not your cost of living. Cost of living includes your income, your debt, whether your wages kept up, whether you traded down from steak to chicken. CPI just asks, did steak get more expensive? It doesn't care if you can still afford it. It also doesn't measure quality changes the way you experience them. If a laptop costs the same as 5 years ago but now has twice the processing power, the BLS adjusts the price downward in the index because you're getting more for your money. You still paid $800, but statistically, that's recorded as deflation in electronics. Your bank account doesn't feel deflationary. The biggest misconception is that CPI includes your actual rent or mortgage payment. It doesn't, at least not directly. For renters, the BLS surveys a sample of rental units and records what tenants pay. That gets weighted into the index as rent of primary residence. For homeowners, the BLS uses something called owner's equivalent rent, which is a weird concept. They survey homeowners and ask, if you were renting your house, what would it cost? The idea is that owning a home is partly consumption and partly investment, so CPI tries to capture just the consumption part by estimating the rental value. This creates a lag. When home prices spike, it takes months or years for that to fully show up in the CPI, because rents adjust slower than sale prices. If you bought a house in 2021 at a 3% mortgage rate and your payment is locked in, your housing cost isn't inflating at all. But someone signing a lease in 2024 might see 10% rent growth. The CPI blends those experiences, so it moves slower than the current market rate for new renters. Your personal inflation rate can run way hotter or cooler than the national average depending on what you buy and where you live. Rent inflation in Austin or Miami has repeatedly clocked double the national CPI for housing because those metros had massive population inflows. If you live there, the national number feels abstract. If your employer didn't raise your pay to match, you got poorer in real terms even though CPI says inflation was moderate. CPI also doesn't capture substitution the way real people do it. If beef prices soar and you switch to chicken, your personal inflation is lower than the index suggests, because the index still prices the same basket, including the beef you stopped buying. Some inflation measures try to account for substitution, but the main CPI doesn't. Another edge case: services inflate faster than goods. Haircuts, childcare, tuition, and restaurant meals have gone up much more over the last 20 years than electronics, furniture, or clothing. If your spending skews toward services, especially labor-intensive ones, you're experiencing persistently higher inflation than the average. Goods prices have been relatively tame or even deflationary in categories like TVs and appliances because of global manufacturing efficiencies. Services can't be offshored the same way, and wages for service workers have climbed, so those prices stick. CPI also excludes some big-ticket items. It doesn't count income taxes, Social Security taxes, or investment losses. It doesn't measure the price of buying a home, only the cost of living in one. If home prices double but mortgage rates stay low, the CPI barely moves because it's tracking that owner's equivalent rent, not the $500,000 price tag. New buyers feel that pain immediately. CPI doesn't. This is why people's lived experience of affordability can be completely opposite of what the inflation rate suggests. Inflation slowing from 9% to 3% doesn't mean prices went back down. It means they're still going up, just slower. If your wages didn't grow 9% during the high inflation period, you lost purchasing power, and slower inflation now doesn't restore it. So when you hear that inflation is 3%, that's a national average of price changes across a standardized basket of goods and services, weighted by typical spending, excluding food and energy if it's core, lagging behind housing market changes, and not adjusting for your specific city, income, or consumption patterns. It's a useful economic signal for setting interest rates. It's a rough approximation of price pressure. It is not a personalized cost of living calculator. Your rent can absolutely rise faster than the average because you're one data point in a massive sample, and averages smooth out the extremes. CPI measures the temperature of the whole economy. You live in one room of the house, and that room might be on fire while the thermostat reads normal.